So, what makes a good or a bad defined benefit pension transfer? Okay, this is a very big question you get in the industry, and it's actually a topic I've covered before with the Financial Times as part of their continued professional development for IFAs in the UK. So to roll back a little bit, obviously the pension freedom rules came into place in 2015, and obviously through evolutions of regulation from the UK government, effectively defined benefit pension holders now have to have safeguarded benefits over £30,000, must be signed off, have a DB report written by an FCA-regulated and FCA-authorized financial advisory firm. And this has obviously put a lot of stress onto a lot of people, and there's a lot of complaints of why should I have to have someone talk to my pension? I saved, it's my pension, I can do what I want with it. The rules are what they are, and obviously we have to follow them now from the UK government. So in terms of suitability, since the legislation came into place, the FCA has basically said there's been far too many unsuitable transfers happening. They are asking financial advisors to assume from the standpoint that a DB pension transfer is unsuitable, and then they have to find the reasons why it is suitable. Over the course of the years, there's been far too high a number of unsuitable transfers, which are generally coming down now as the FCA is stepping on things. So as we move into looking at what potentially could be some good reasons for a client or rationale to maybe want or to consider consolidating down the DB pension transfer. The first one is reduced life expectancy. So obviously, if you have ill health or you have serious ill health, which means within a period of 12 months, you think something's going to happen to you, effectively that's a very good reason for wanting to say, I would like to opt out of my defined benefit scheme and the guaranteed annuity that I'm going to have for life, because I might not have that longer life. So that's a pretty good reason as why someone might want to start thinking about transferring. Ironically, another one is if you are facing financial difficulties. Say you have a DB pension pot on a seated value of £500,000 and you have a debt of £100,000 that you simply cannot clear from any other resources in your life. It may well actually be advisable for you to potentially take your DB pension pot, pay off the £100,000 debt that might be causing you stress and causing interest, and then maybe buy an annuity with the remaining £400,000 or invest the £400 into the equity market. So that's a consideration as well. Income flexibility is another big one for clients. Many clients may want to continue working in the early years of retirement or doing consulting work. It may take them into a 20, 40 or even 45% tax band in the UK. Do they really want their guaranteed income for life to pay from age 60 or 65, the typical normal retirement age of a DB scheme? Possibly not. It could be very poor tax planning to keep a DB scheme and have a guaranteed income of whatever it is, 10, 20, 40, 50k per life after age 60 or 65. Obviously, unlike transferring to something like a SIP, where they could obviously manage the flow of that, they might not take any income at first in the first 5 or 10 years. Once you stop working and want to stop consulting, they may then want to draw down money from the SIP, but at a lower tax rate because they would no longer have any employment in place. Marital status can also be a big point as well. If you're divorced or you simply have no spouse, you may be looking at your scheme and saying, well, all of my former colleagues have a spouse or someone that money can pass to. Typically 50% of the annual pension that we pay to you would be paid to your spouse in the event of you passing away. In some instances, they'll pass on maybe 25% to anyone, children, typically if they're in higher education and fully reliable on you. Another one is nominating beneficiaries. Now, this is a bit of a catch-22 because most of my clients, I would say 90% of clients say, I would like to nominate my spouse and my 2 kids. I would like the money to go to them directly. I have a big fear of losing half of my DB scheme. I would like to pass on 100% of my SIP. This I can see as being a very good rationale and an idea from a client. A lot of pension transfer specialists will say that, well, actually, you could just take out life insurance and you don't need to pass the money on through a SIP. You get 50% to your spouse from your DB scheme. The other 50% you could buy life insurance. But a lot of my clients say, well, I don't want to spend £1,000 or £2 every single year in retirement to have life insurance when I could just transfer it out in the first place and know that I can guarantee to give 100% to whoever I wish. Obviously, the important point with beneficiaries is it can be anyone. It could be your spouse, your husband, your wife, your partner, girlfriend, boyfriend, mum, sister, cousin, kids. You can do whatever you want with money whilst it's inside a SIP. In a defined benefit scheme though, it's very rigorous and it's pretty much only spouse or children as just mentioned. Another key reason is lifetime allowance. If you're approaching your lifetime allowance of 1.073 million, you may well be better off utilizing a QROPS, which obviously would require you to transfer out of your defined benefit scheme. However, it's quite technical. You'll be triggering your BCE 8 benefit crystallization event, but also when you transfer out a CETV, once you get it inside another structure, there's a little bit of tax plan you need to have a look at there with a financial advisor before you move ahead with that. Moving on to page 3 of the article. The next point is that SIPs generally have a much better choice for you to do with your investments. So whether you want to go low risk, medium risk, high risk, whether you particularly maybe want to hold different currencies inside an international SIP, you have far more control over that investment process. Some clients might say, Dominic, you know what? I am reaching retirement age of 65. I know I should, technically speaking, be de-risking my portfolio, but you know what? I've already got £1 million in ISAs, or I've already got £1 million somewhere else. I'm not going to draw down on this pension. I want to pass this pension on to my beneficiaries. I would like to continue to maintain a balanced adventurous risk profile for the next 10 years up until age 75, because I don't want to draw down on this capital. I have other resources. So you have much more flexibility compared to a DB scheme where you, all your former employees, everyone is invested the same. You have a guaranteed income for life, and it's not necessarily dependent upon stock market returns. Another one is other assets. And now when I wrote this article, even in 2021, I believe, or 2022, other assets was seen as a positive. You know, if you have other money and you don't particularly need this DB, then it's less risk you transferring it. Now PTSs maybe look at that the other way and say, well, actually, if you do have other assets, why are you even considering transfer in the first place? If you have £1 million in your GIA account, then you definitely don't need to touch your safeguarded assets, which are index linked, etc., etc. So other assets is a bit of a can be a bit of a double-edged sword. Another one is company liability, or the final one is company liability. If you're looking at your DB scheme and you're really up on it and you read all their accounts and you check all the information and you think, wow, these guys are in a pretty big deficit, I don't see how they're going to fill the deficit, and you don't trust your company to fill that deficit or honour the payments that the projected to pay you over the course of time, it may well be a time to consider, at least considering getting a report written by a qualified and authorised pension transfer specialist to understand what your options might be. It's important to caveat that even if your DB scheme were to go into financial difficulty, you do have the pension protection fund, which would step in and honour 90% of your payments on an ongoing basis. The problem with going into pension protection fund is once you're in, you can't come out. You 100% cannot transfer once you've already entered in that. Now I'm going to flip it and look at some of the things, some of the possible reasons that might make up bad transfer rationale, or obviously things that can negatively impact you as a client. Number one is most important, is loss of income. You will be losing that guaranteed income for life for the rest of your life. For many clients I speak with, this would be the worst thing they could possibly do with their finances. They cannot afford to go and take risk with that capital. They have a family, they have children, they have bills, they have large mortgage payments to complete. They cannot take much risk. Well, they can, but they shouldn't necessarily, or it's not advisable for them to take risk and to transfer that guaranteed income instead into something else. The other point is understanding the risks. Now, within a final salary pension scheme, the risks are all borne by your former employer and the pension scheme and the trustee who's running it. You take zero risk. At the end of the year, your defined benefit pension is guaranteed to grow, typically in line with inflation, maybe a little bit more, and you don't have to do anything. You haven't got to find a financial advisor, you haven't got to decide your risk profile, you haven't got to decide what to invest in, equities, whatever. It's not your problem. You can do whatever you want in retirement. Now, the caveat of that is that your defined benefit scheme might not necessarily be growing the same as what the equity markets might be growing, but it's a guaranteed income, and that's obviously very, very valuable to you. As we move on to page 4 of the report, it also goes on to talk about income shortfall. So if you have limited other assets in your life and your DB pension pot is going to be your mainstay of your retirement, you really have to be asking yourself, do you really want to move away from a guaranteed income for life, which is index linked and is guaranteed to grow whatever happens? If the markets go up, down, sideways, flat, you'll continue to have growth. Do you really want to give that up? Now, if you don't have many other assets and you really are reliant on DB, the answer would almost certainly be it's not necessarily advisable for you to do that. Again, I've already touched on this one. Next one's inflation. So within DB schemes, you're effectively inflation proof. Now, by how much you're inflation proof, we need to have a look at your CETV. If you want to have a look at your CETV first, you can book in below via the comments section. You can use the calendar link, or you can also drop me an email or just head over to the website to leave your details. We would need to look at your CETV to work out exactly what your stipulations are. But typically speaking, you'll be above inflation with inside your DB scheme, which obviously is extremely valuable to you and potentially your family. Moving on from that as well, there's a bit of degree of financial security in terms of your retirement. By transferring out, you are removing a valuable safety net, protect you and your family later in life. So really, that's kind of a summary of the main points. Now, I wrote this article about a year ago. Even in the space of the pension transfer landscape, a few of those points and things are changing over the course of time. And what was suitable 1 year ago, or what might have been a borderline case 1 year ago, would now almost certainly be a negative transfer or a negative outcome, which means the advice of the PTS officially is to retain that DB safeguarded asset. So I'd say it's getting more and more and more difficult to attain a positive transfer outcome for your DB assets. Now, here at Cameron James, we're quite unique in the fact that at the time of recording in 2023, we are able to proceed with clients on a retained client basis, which is effectively where they go through the authorized DB pension transfer advice process with the PTS. And then they say, thank you very much for your advice. Based on my own desire and rationale, I believe I did in my best interest to move ahead with this. And they use their statutory right, which obviously people often call as an insistent client. For us here at Cameron James, it's a retained client because of the advice that's being given by the PTS first. And they're able to proceed with that business anyway. This is only on a case-by-case basis here at Cameron James though, because effectively if someone has been advised not to transfer, typically speaking, that might well be what's in the client's best interest. Some common examples of that might be, we've had clients recently have, say, £5 or £6 million in other assets outside their DB. They've got a £1 million DB and they're thinking, well, I like my DB scheme, I like the uplift and everything I get from it, but I want to go adventurous with this portfolio. I want to pass it on to my kids. I want to keep it until 70, 80, 90. I would like to take far more equity risk, and I believe I could outperform the inflation proofing of my pension scheme. So I would like to invest it in a SIPP with Cameron James or another financial advisor and obviously get the money growing. But what the PTS would say and look at that is say, well, I understand you're quite a wealthy person. I understand this pension pot's not your biggest asset in the world, but it is still a guaranteed income, and why would you give that up? So that's kind of some of the situations that on a case-by-case basis we would look at and review with our clients to see if we're able to proceed with them as a retained client. Guys, I hope that's been valuable for you. A lot of information there, but really good summary of some of the key points. And again, it's really important to note, any of the information I give you here is not DB pension transfer advice. I can't ascertain by telling on video if it's suitable or unsuitable for you. You have to go through a rigorous, authorized and qualified advice process with the PTS before you're even in a position to make any informed decision on your safeguarded assets. As always, guys, take care with your UK pension assets.